Yo, what's up everyone? Welcome back to Smashing Goals. Today I want to talk about Nvidia since they just had its earnings call and the stock barely moved. I know some of you were expecting it to go to the moon, especially with all the hype around AI and their dominant position in the GPU market, but that's not always how it works in the stock market. We're going to break down the top 5 reasons why Nvidia's stock didn't skyrocket as everyone thought it would. But before we get started, don't forget to like, subscribe, and share our videos. Seriously, it helps me out so much and it takes 2 seconds. All right, let's get into it. First things first, Nvidia's stock has been on an absolute tear lately. Seriously, it's been going up like crazy. And you know what happens when a stock goes up a lot? Investors start to expect huge things. They bake those expectations into the price, meaning they're already betting on amazing earnings. So even if Nvidia comes out and absolutely crushes their earnings, beating every analyst estimate, it might not be enough. The market might have already priced in that amazing performance. Imagine you're buying a pizza and you know it's going to be the best pizza in the world. When it arrives, it's just as amazing as you expected, but you're not surprised. Nvidia's earnings were like that. Good, but not surprising enough to send the stock even higher. The expectations were so high that even a strong earnings report wasn't enough to really wow the market and send the stock soaring. Here's something a lot of people forget. The stock market isn't some isolated bubble. It's connected to everything else going on in the world. Think about it. The economy, interest rates, even politics, all of that plays a role in how the market feels. Investors get scared and they start selling everything, even if the individual company is doing fine. On the flip side, when the economy is booming, people feel good, they spend money, and the stock market usually goes up. So even if Nvidia had amazing earnings, if investors are worried about a recession, inflation, or some other crazy thing happening in the world, they might not be in the mood to buy stocks. Sometimes the overall market sentiment can overshadow good news from individual companies. All right, imagine you bought a stock and it doubled in price. What would you do? Some people might hold on, hoping for even bigger gains, but a lot of people would probably think, okay, time to take some profits. That's exactly what profit taking is. When a stock has gone up a lot, like Nvidia has, some investors might decide to sell some of their shares to lock in their gains, especially if they're feeling a little unsure about the future. This can put downward pressure on the stock price, even if the earnings are good. Investors can do the same thing with stocks. They might take some profits off the table after a big run up to protect their gains and reevaluate the situation. So even if Nvidia's earnings were fantastic, some investors might have decided to sell some of their shares simply because the stock had already gone up so much. Okay, so Nvidia just crushed their earnings. Great. But what about the future? What do they see happening in the next quarter or the next year? That's where forward guidance comes in. Forward guidance is basically a company's prediction of its own future performance. Investors pay very close attention to forward guidance because it gives them an idea of where the company is headed. If Nvidia says, hey, we're expecting even more growth next quarter, then investors get excited and the stock might go up. But if Nvidia says, well, things are a little uncertain right now, we're not sure how the next quarter will play out, investors might get nervous. So even if Nvidia had amazing earnings for the past quarter, if their forward guidance was a little shaky, it could have easily overshadowed the good news. Okay, this one's a little more complex, but stick with me here. The stock market isn't about earnings reports and company performance. There are also these things called technical factors that can influence how a stock moves. Think of it like this. Imagine a river with a bunch of rocks and rapids. The water, that's like the company's performance, wants to flow freely, but those rocks and rapids, the technical factors, can create resistance and change the direction of the flow. Technical factors are things like, imagine a stock has struggled to break through $100 per share in the past, even though it's come close a few times. The opposite of resistance, these are lines on a chart that show the average price of a stock over a certain period. So even if Nvidia had amazing earnings, there might have been some technical factors at play that prevented the stock from skyrocketing. Listen, just because Nvidia's stock didn't go crazy after earnings doesn't mean it's a bad investment. Remember, this is a long-term game. The company is still a leader in the AI and data center space, and the demand for their products is only going to increase in the future. Look, we all love a good success story, and we love seeing stocks shoot up like rockets. But the reality is, the market is more like a roller coaster. Don't let one earnings report or lack of a massive price jump scare you away from a solid company like Nvidia. And hey, if you learned something new today, make sure to hit that like button and subscribe to my channel for more videos just like this. I'll see you in the next one. Peace out.